All right, we are on chapter 11. This is the first chapter of Principles of Accounting 2. We just ended Principles of Accounting 1 with chapter 10, and now we're beginning with 11. So you can see we're just not missing a beat. We're just going to keep on going in this exact same book. All right, this chapter is over current liabilities and payroll, and I kind of wanted to remind you, might have been a little break from Principles 1 to Principles 2. Got my accounting equation out here. My assets equal liabilities plus equity. Equity is going to change a little bit here in the next chapter, so that's why I just put equity, not owner's equity. Okay. The assets are made up of current assets and long-term assets. That chapter 10 that we just did, that was the long-term assets. Now we're going to do a chapter on current liabilities. Okay. Let's jump back over here. In this section, we are going to do a video on 11.1 and 11.2, and then we'll combine 11.3 and 11.4, and we will not do 11.5. Okay, so let's get started. We are talking about in this first learning objective about current liabilities that are a known amount. Okay, that's really important because these are the ones we know about. We have a whole section on liabilities that we don't know the amount. Okay, so we'll talk about that in a few sections. But right now we're talking about known amounts. Okay, what are liabilities? You know what a liability is because you've been listening to me for the last 10 chapters through Principles 1 and now Principles 2. Liabilities are debts we owe, or remember, it doesn't necessarily have to be something that we borrowed. We could have had a customer pay us in advance and we got a liability. We have a liability, $1,000 to do somebody's tax return. That is, we don't owe them $1,000, we owe them the service of $1,000. Okay, three main characteristics. It occurred as a result of a past transaction or event. It creates a present obligation for future payment, and it is an unavoidable obligation. We have to pay it. Okay. I've already kind of broke down the current liabilities, long-term liabilities for you at the beginning of this objective. Remember, current liabilities are those things that you're going to pay within the coming year. And just as a reminder, in case you forgot, we break these out between current and long term because we want to know, do we have enough current assets to pay our current liabilities? Okay. There is a ratio called the current ratio, and it is just current assets divided by current liabilities. We hope that this is at least a 1-to-1 ratio, but 1-to-1 ratio would be like me and you having only $1 in our checking account for every dollar we owed in liabilities. So we like something a little higher than 1-to-1, right? 1-to-1 is good, but we want something a little bit higher than that usually. Okay. Not something crazy like 50-to-1 or 100-to-1. That's way too much. Okay. So here are some of the accounts that you might see for known amounts. The current liabilities, you could have an accounts payable. Notice there is not an accounts payable on the long-term liability side because these are always short-term. Okay. They're very short-term. There's no interest element in them. There is probably no business that's going to extend credit to you for over a year and not charge you any interest. So that's why you don't see an accounts payable over here on the long-term liability side, because if anybody's going to finance something for you over a year, they're going to have an interest element to it, and it would be then that notes payable. Okay. Sales tax payable, these are the things we have to pay coming up within the next year. Then any unearned revenue. Remember this account, if you just the prefix changes it from a revenue to a liability. Okay. So if there was not that prefix, earned revenue, that's a revenue account, right? But we have that prefix UN, which means unearned. We have not earned it yet, but we did get the cash for it. Okay. So they're going to give us an example here of sales tax payable. There is not a thing called sales tax expense because it's not an expense. We as the business are just collecting that sales tax for the government. Okay. So here they tell us December's taxable sales for Smart Touch Learning total $10,000. The company collects an additional 6% sales tax, which equals $600. So they're going to get cash of 10,600. Okay. Only 10,000 of that is sales revenue. Okay. This is where some businesses, this is why revenue recognition is such a huge thing. Like they've actually changed some rules because some businesses would have thrown that all into sales revenue and then took it out later. That's a little bit misleading. It looks like you had $10,600 of revenue when you really did not. You only had $10,000 of revenue. And then we're going to credit the 600 that sale to sales tax payable because we're going to pay that. We just collected. Now, they don't show this entry, but most of the time the government, the state of Arkansas does this. They give a small break for what's owed on the sales tax payable because they cut the businesses a little bit of that because they're actually doing the collecting of the revenue or that sales tax revenue for the government. So a lot of times the whole 100% won't go out. It's usually you might get like a 2% off of that 600, not 2% off of the 10,000, but 2% off the 600. Okay. So not an expense. Okay. When they get ready to pay that $600, they're going to debit that sales tax payable and credit cash. And they're going to send that out. That's probably going to be a checking account and it's probably going to get sent as a check. I don't know if that confuses y'all, but I know when I was first starting out in accounting, they kept doing all these things with cash. And I was like, why are they using cash? Why don't we have checks? When they say cash, they are meaning a checking account. Okay. All right. Then income tax payable. Now, this is going to be an expense because this is a tax of our business on us. Okay. So Smart Touch Learning incurs federal income tax payable of 3780. They didn't make you calculate that. I'll be teaching tax here in the next week. You don't want to learn how to do that calculation right now unless you're an accounting major. And then, whoa, yes, you can come and learn how to calculate that with me. All right. We'll debit the expense, credit the payable. Notice this is a December 31 entry because this is an adjusting entry. Okay. It needs to be on the December 31 current year's books so that that expense is matched. We'll talk a little bit about that matching. I know we've talked about it before, but we're trying to match up expenses with revenues that we earned. Okay. When they actually pay it, they will debit that income tax payable and credit cash. Notice the income tax payable was credited there and then debited here. That income tax payable account just holds it so we can cross the year end. Okay. So now let's talk about unearned revenue. Okay. Unearned revenue. This is where client gives them some cash. So they're going to receive $900 in advance on May 21st. They're going to get the cash. They have not provided the service yet because they said this is for a month's worth beginning on that date. Okay. Credit unearned revenue. Okay. Then they come on to tell us during May, Smart Touch Learning delivers 1/3 of the work of the revenue. So on May 31st, the accounting clerk records the following entry. This will be an adjusting entry as well. Okay, so notice the unearned revenue is being debited because we're making it go down. I'm just going to come over here and draw out unearned revenue T account. We put 900 in there. We earned 1/3 of it, so we're decreasing that by 300, and now we have 600 left in that unearned revenue. Okay. So that was an adjusting entry. They must have been doing financial statements like as of the end of May 31st there. Okay, look, they did the T account, but I'd already done it. Okay. All right, let's talk about short-term notes payable. Okay, short-term notes payable. This is a written promise by a business to pay a debt, usually involving some interest of 1 year or less. Okay, 1 year or less. So they tell us on May 1st, Smart Touch Learning purchases merchandise inventory with a 10% 90-day note payable for $8,000. Notice they told us perpetual inventory system. I wonder why they told us that. Because we learned about inventory in Principles of Accounting 1, so you should know the difference between perpetual inventory and periodic. Okay. So we need this 10% and we need this 90-day note payable. We need that information, but we don't necessarily need it to make the first entry on May 1st. Okay. On May 1st, we're purchasing some merchandise inventory, and then we are going to credit that note payable because we owe for that now. Remember back up in Principles 1, this might be accounts payable or even cash. Well, this was a big chunk of inventory, and they must not have, they know that they don't have the cash right now. So they're asking, hey, we want to purchase this inventory. We don't have the money now. We'll have it in 90 days, plus we'll give you 10%. Okay. So they told you perpetual because that is what told you to debit merchandise inventory. Okay. Then we're going to come down here. Then they said July 30th, when the note is due, Smart Touch Learning pays the note plus interest. Let's calculate that interest really quick. Okay. Remember the formula is principal multiplied times rate multiplied times time. Okay. Our principal was 8,000. Our rate was 10%. Our time, I'm going to scooch down because I want to see what they did. They did 90 divided by 365. Just be sure you look at the problem, you know what everything they're saying. Sometimes they'll tell you 360. Okay, I should have my calculator pulled up already, but here we go. So we're going to take the 8,000 and we're going to multiply that times 10%. That gives us 800. A lot of students want to stop right there. Don't stop right there. Remember, this rate is an annual amount. That 10% is for 12 months, not 90 days. Okay. So we have to take this 800 and multiply it times that fraction of 90 divided by 365. To reduce your rounding error, always do your multiplication first. Multiply times 90. It's going to give you a big crazy number. Then divide by 365. Ooh, we got not a round number, but we got it close. Okay. Our rounding error is a lot less when you do it that way than if you took the 90 and divided by 365. Okay. So 197 is the number they used. So that's the interest. We're going to add the principal. So that's 8,197. That's how much cash is going to leave us because we are paying all the principal and the interest on this loan. Okay. So this is one of those I tell you to figure out the cash. I'm just going to pull the journal entry up, but if figure out cash, then sometimes you can reason your way through the other part of the equation. We only put $8,000 in the notes payable. Notice we did not put the interest into notes payable. Okay. So that account has to be debited for the same amount that we credited right up here. Then our difference is 197, and that will be interest expense. Okay. And all right, now sometimes businesses will actually borrow cash from banks, and a bank requires a business to sign a promissory note stating that the business will pay the principal plus the interest at a specified maturity date. Okay, so we have another one here. On November 1st, Smart Touch Learning borrows $10,000 from First Street Bank at 6% for 5 months on November 1st. Okay. November 1st, we are going to make the journal entry to debit cash, credit notes payable for the $10,000. Okay. We need all those other things. We just don't need it right here for the November 1st entry. Okay. I'm imagining the first thing they're going to do is make us accrue interest on December 31. Okay. So let's do our numbers again. Principal multiplied times rate multiplied times time. We have 10,000 multiplied times 6%. And then we're going to multiply it times that fraction of time because the 6% is an annual amount. Okay. And they just use the fraction 2 divided by 12. You could do 1/6. That is fine as well. I believe you'll get the exact same number. So let's put this in our calculator. 10,000 multiplied times 6%, 600 multiplied times 2 divided by 12 gives us $100. Okay. So this is a December 31st adjusting entry. We're going to debit the expense and credit the payable. There's no cash involved here because we're not going to pay it for 4 more months. Okay, so there's no cash involved in this adjusting entry here on December 31. Okay, now they're going to actually pay it. I think they're going to pay it. Let's see here. So on 2025, the interest on the note for the 3 remaining months is $150. Okay. We could have calculated that because we know it's a 5 month note. Let's just let's just do that for the fun. Principal multiplied times rate multiplied times time. So principal 10,000, rate is still 6%. We could multiply this times 5 divided by 12. Okay. There's a couple of ways you could do this. What I'm doing right here is calculating the entire interest for the whole 5 months. Okay. So that's for 5 months. I did 2 up here was 100, 250 minus 100 is $150. Okay. But we're going to pay the entire $10,250 in cash. Okay, so figure out your cash. Cash is going to be maturity. That's called the maturity value. It is the principal plus the interest, all of it together. Okay, we're going to debit the note payable for the principal. We are going to debit interest expense for the 3 months that we had interest in 2025. The $100 comes from the interest payable right up here. Okay, we're debiting the interest payable because we credited it up there on December 31. Okay, interest payable just held it to cross the year end so we could get 2 months of interest in 2024 and then 3 in 2025. There we go. All right. That is all for this objective. I will see you in the next video.